actually have the recording done. So this is Ken Long from Tortoise Capital, and we're going to take a look at some chart of interest on the evening of March 20th, 2011. Okay, so the first one we'll take a look at, excuse me. The first one we'll look at is, let's see, BA. I think it's Boeing. I like this one. What we have is 2 days up. And doji price action. A very tiny little doji, so an entry around 69 3/4. If it gets through its 50-day moving average at around 70 3/4, it gets to 72 and some change pretty quickly. A measured risk. Even the sell-off on Wednesday wasn't all that bad, and it held support above its 200-day moving average. So with the slope of the 50 positive and the 50 better than the 200, and just coming out of channeling conditions, I think this is a low-risk trade. So if we see strength in SPY and BA doing better than the market, then that's an easy entry, mechanical entry around 69, looks like 69 or 69.65. Next one up is Asia less Japan. This one is difficult to trade intraday. You can see the size of the gaps, and you want to respect that. That's why I don't want to hold this one overnight. The gaps can hurt you. However, if we see intraday price take out 44.75, then I think that's one that we can trade intraday. I want you to look at the height of the white candles on this one. Once it starts moving intraday, it's possible to take advantage of that move on a one-day trade, and because that doji from Friday is so small, there's a very good possibility. And yeah, for intraday only on this one, Lee. So the EPP was the second worst ETF in the entire, among all 10 regions, and so I have no confidence in this thing overnight. The gaps are brutal. These when it fails intraday, it's brutal, but there's a possibility of an intraday move, which could happen. I mean, you can play EPP and get a general rebound in Asia intraday with no overnight risk if it's moving, and if it's moving better than EWJ. BA is one that I would consider holding overnight if it closed strong. If the market closed strong and BA was closing strong, I would consider holding that overnight using 3 ATRs as my overnight protection, and only because its chart was relatively good. The next one is EWZ, and this is Brazil. Now this is, you can see this is a much better chart as an index compared to EPP. It didn't make a new swing low on Wednesday's sell-off, and Friday was an up day. It gapped up and then closed higher, and the rest of the indexes did not do that. So EWZ is a leading contender for index regional strength. It held support above its 200-day moving average, the red line. You can see an easy entry at about 73.6. It gets through its 200-day, 50-day moving average at 74 1/4 pretty easily. Gets to 75 and then 76. And then if it gets north of 76, it's clear that the bull will be back inside Brazil. And I think, again, Brazil is winning because it has oil and it's not Asia or the Middle East. So that should be on your short list for the next couple weeks. And that is one I would hold overnight. ILF, you can see the pattern looks relatively similar to EWZ, but what I want you to notice is that it actually did make a swing low on Wednesday. So the rest of Latin America is weaker than Brazil. It's clear that the strength in Latin America is coming from Brazil because it was a white candle on Friday, whereas ILF was a black candle. It made a higher low on Wednesday, whereas ILF made a lower low, on a lower swing low. So I want you to notice the difference between those two charts. That's very important. It's a longer move to get back to the 50-day moving average in ILF. And so although this is tradable, my clear preference would be EWZ over ILF. This is Intel. This is a 10-day max pain, and you can see why. It's down from 22 down to 19. That's a 10% pullback. However, it's had 3 days in a row of higher lows, 2 days in a row of dojis, and then if it gets above 20.2 and closes the gap to 20.8, you can see that you've got a very favorable trade in, and then it can get back to 21.2 pretty easily. However, this is one that I'm going to trade over the course of the next week. I'm reluctant to hold this overnight because of the weakness in technology, but this is definitely one that if we see technology turn around, then Intel has to be a leading candidate for us. I like the doji action. I like the 3 days of higher lows. I'm not prepared to hold that one overnight yet. Next one is IWM. This was better than SPY. It's had 4 days of higher lows. It actually had a little white doji on Friday, whereas SPY was negative. It had a tight range. So if it gets north of 79.5, I'm willing to buy it. I'm willing to hold it overnight, especially if it can close above its 50-day moving average, which is about 80 and a quarter. With that, I'd look at targets at 81 and then 82. If we see money flowing into the U.S., that will be a good tactical trade. You can use UWM as the double leveraged Russell small cap. Now, however, if it fails below 79, there's a good short target at 77.5. That's easy to reach in 1 day. Take a look at the size of the red candles intraday. If IWM rolls over and starts failing, that one is a definite short candidate. If it falls below 79, then your target should be TWM with an effort to try to get a 1 day intraday only move the size of one of these other red candles. Just look back the last 20 days. That's why you got to be interested in the small caps. Johnson & Johnson, a nice tight doji. It closed near the high of the day. If it gets above 58.75, then you can see clear targets at 60 and 61. That one's tradable because it's a defensive stock. That's one that I would hold overnight. Kraft is the 551W. I like it because it made a higher swing low on Wednesday's sell-off. You can see that it, around February 14th is the previous swing low. Even in the panic selling on Wednesday and Thursday, it did not make a new swing low. So I like it for that reason. So a buy above 31.1 with a target of 31.8, and that's one that I would hold overnight, especially if it's outperforming SPY. I won't hold anything overnight that's not outperforming SPY intraday right now. McDonald's is a max pain. This is one that I'm willing to trade intraday in the yellow zone only. I won't hold that one overnight because it's still at the tail end of 3 days of selling, and it closed below its 200-day moving average. But it closed so poorly that I can see a 2-to-1 inside the yellow zone, and then that would look like holding support at the 200-day moving average. And then if it goes through the green line, a mechanical entry on a max pain with a target at 74.5, 75.5, and going all the way back up to 77 eventually. That could be a nice swing trade in a defensive stock in a defensive sector. The mid-caps are the strongest of the U.S. indexes. Friday was a doji, even though it got weak, but it did come back and found support at its 50-day moving average, buying it at 172 on a mechanical entry with a target of 179. VXX is an intraday trade. This is tracking the volatility. You can see the power of 1 day intraday moves inside the VIX. I don't like holding it overnight because of the size of the gaps. If I do, I'm using 3 times ATR percentage. The ATR percentage on this thing is 6%. So 3 times ATR is a 20% overnight hold. That equates to $6, or I'm sorry, $7. You should be using a $7 overnight stop for any position inside VXX. But you can see based on the size of the white candles, and really even the red candles, why that makes a good intraday intraday trade. All right, so those are the charts of interest. I'm going to process this one and hang it on YouTube and hang the video inside the chat room. The chat room has the marked up trades already. So there was one other question that came out of the surveys that I wanted to address, and that was, with the increase in volatility, should newer traders stand aside? And my advice to you is no. You should get stick time in volatile markets. What you have to do is account for the increased volatility, and that is use wider initial stops and a much wider overnight stop. For example, 20% in VXX is a $7 initial stop. All you have to do is get used to accounting for the increased volatility. Let your powers of math guide your decision making. The only way that you will get proficiency as a trader is to trade, and there are intraday profits to be made in volatile markets. That's how you distinguish yourself from the herd. You have to become experienced in doing that, but the way to do that is in a risk-measured way. Understand the volatility, understand the size of it, and use it to account for the initial stops. For instance, 60 days ago when the market was in bull quiet, we might have been able to get away with a routine initial stop of 5 cents or 10 cents. Well, the volatility intraday has gone up 3.5 times since then, and so now a lot more of those 10-cent initial stops are getting hit through normal market noise. Well, 2 months ago, that was not intraday noise. That was a significant move. But now, because of the increased volatility, a 10-cent initial stop may be too close. That may be inside the noise level. So you have to vary your initial stop and your risk management stop to account for the realities of volatility. That's why you got to pay attention to ATR percentage. That's why you should be focusing on a limited set of targets that you have good market knowledge of. That's where part of your edge as an individual trader comes from. So I'm going to stop the tape there. I will hang this video tonight in the chat room and on YouTube, and we'll see you in the markets tomorrow. I'm glad to be back home from the trip in Florida. It was a good conference, but it's always much better to be home, much better to be trading. So we'll see you tomorrow. God bless you. Keep your powder dry and your risk managed.